First of all, let me say, Dr. Tumpel-Gugerell, thank you so very much for joining us on Bloomberg TV. Can I start off by asking you, the last ECB monthly report said inflation would be above 2% this year. At the moment, it's close to 3%. Could it be as high as 3% this year?
Of course, we are only in the middle of the year. We are closely monitoring inflation figures. We know that we have a cost push at the moment coming from commodities and food prices, and we are expecting a lower inflation rate for next year.
There's been a recent spike in commodity prices. Are you concerned about inflationary pressures, these so-called second round effects, meaning that inflation could get into the wider economy?
It is important what now happens with these price increases, which are let's say, having an impact on producer prices, on prices of final goods. It's important that neither the producers nor the consumers expect inflation to go up further. And it's very important to, let's say, keep this confidence that the cost push can be kept under control and does not lead to higher inflation rates.
How does the ECB manage that to try and control those inflation expectations?
We have made very clear with our recent interest rate increase that we are committed to fight inflation. This is our primary task, and therefore it's also important that I would say all the economic agents are convinced that we will succeed.
Markets have interpreted the code words of the ECB, language like strong vigilance and monitoring very closely. Have the markets gotten it right?
I think the markets are quite good in, let's say, taking up certain elements of our communication. What is important is that we make a new assessment of the economic situation each month. Then the discussion takes place and then the decisions are made. So there is no prior commitment to any direction of monetary policy.
Well, I might press you a little bit on this point. In last month's communication, the language monitoring very closely was used. Does that rule out a rate rise in June?
The Governing Council in June will discuss the situation. We'll have also new projections available, and I think this Governing Council, which I will no longer be member of, will then take a decision.
You've talked about getting interest rates back to a more normal level. What do you think a more normal interest rate should be?
We have to keep in mind that our monetary policy stance is still accommodative. And interest rates level, of course, have to be consistent with the level of economic activity and also with the risks to price stability. And these elements taken together lead then to the adequate and appropriate interest rate level.
Because one thing we've talked about before is how you assess the current credit conditions, because that determines interest rates and the cost of money. And looking ahead, how does the financial system look to you?
I think the financial system has overcome the crisis of the last 2 years. We see demand for loans picking up. This is very important for further economic activity, for investment activity. And therefore, I think we are on a very good path. And in this sense, also the conditions for taking a loan are still very favorable.
So money markets have gotten back to normal operation?
Yes, money markets have gone back to normal operations. This means banks are trusting each other again, and also the assessment of borrowers has improved, of course, because the overall economic conditions have improved. Therefore, it's important that demand for loan is picking up also.
What other indicator do you look for? Is it just demand for loans, or is it the lending rate that banks lend to each other at?
Both, and of course also the assessment of the quality of the borrowers. Here we use our regular bank lending service as a basis for our discussion, and here we see that the access to finance is very important, and it's also important that also small and medium-sized enterprises have the possibility to get loans.
There are a number of Eurozone banks still reliant on the ECB for financing. Would an interest rate make their situation more difficult?
First of all, we should keep in mind that fewer banks are now relying on central bank liquidity. This is very good progress. And of course, it depends on the overall package we offer, in the sense that for the time being we have, let's say, generous liquidity provision. And we will sooner or later also phase out our special measures which we have taken during the crisis. And therefore it's very important for the remaining banks also to get the confidence of the market and to get access to market financing again.
Thinking a little bit about troubled banks, particularly in Greece, there's a lot of debate over what's going to happen with Greece. Are there any contingency plans to help Greek banks should an adverse outcome like debt restructuring happen in Greece?
So far it was possible to provide the liquidity for the banks. This is important so that Greek banks can also lend to Greek entrepreneurs and to Greek borrowers, and we will continue this policy.
I'm going to move you slightly to a different topic, and so you've worked with Mario Draghi. I don't want to ask you specifically about him, his candidacy is being discussed, but I just wondered, given all the challenges facing the ECB, what is the biggest leadership challenge for the ECB in the coming years?
The President of the ECB has a responsibility within the Governing Council, let's say, leading the monetary policy debate, listening carefully to all the positions and then draw the conclusions. I think this is a great challenge, and this is the first task of the President. And then, of course, there are challenges in the field of financial stability, reform, and I would also say of using the new institution of the Systemic Risk Board to make an assessment of the financial sector and to issue recommendations and, if necessary, also warnings.
How does that work, in terms of the Financial Risk Board and then the operations of the ECB?
The Systemic Risk Board is supported by the staff of the ECB, but also by the Scientific Advisory Board, by the staff and work of the national central banks, by input from the national supervisors, and of course also by input from the European agencies, the new banking and supervision and insurance agency and the market supervision agency.
So there's quite a lot of coordination that's needed there. The reason
yes, but it's I think the Systemic Risk Board had a very good start and has very important discussions.
Because I know that you're also a very respected academic, and one of the questions that I found fascinating in this crisis is how you deal with inflation and then how you deal with the banking sector, liquidity.
I think this is part of a central bank mandate since hundreds of years, I would say. And therefore we bring the different tasks of central banks and supervisors I think closer to each other. There is more coordination necessary, and I think this was an important step to be taken, namely to combine monetary policy considerations with financial stability considerations.
It doesn't compromise the independence of central banks?
No, not at all.
No compromise in the inflation target?
No.
Okay. Very finally, when you step down from the ECB Governing Council will lose its only female member. Do you think it's important to encourage more women into top policy-making roles at the ECB and at other central banks?
I'm very much encouraging women. I have very good female economists, experts in my team, and this is also the case in other central banks. And I think there should be no limit for careers in central banking.
That's a great note to end on. Thank you very much for your time.
Thank you.
It's a pleasure. The whole coordination issue, so you're very happy to redo that. So I'll ask again, how does the task of this new systemic risk board mesh with the task of the ECB?
First of all, the staff of the ECB supports monetary policy preparations, but supports at the same time also the work of the Systemic Risk Board. The Systemic Risk Board will bring together the expertise of supervisory agencies, central bankers, and develop a European view on issues of financial stability, stability in the banking sector, insurance sector, in the markets, and this board can also issue recommendations and warnings.
Is it going to forestall the next asset bubble?
As we know from research how difficult it is to define and detect the bubble ex ante, but there are certainly lessons from the past crisis, and I think excessive credit growth will be part of the discussions which could take place.